So we're all here. So let's get officially started. So welcome everybody to this thesis defense by Zhicheng, Zhang, James, as we know him. 3 essays on Chinese banking and corporate finance. James, I think we're going to go for 30 to 40 minutes presentation of your 3 essays.
Okay.
Then we will have questions from and comments from the jury. And also we'll leave the floor open for questions from the large audience that we have here today. At the end, probably around 11, we will have a representative from the Dean team, Salvatore Di Falco, Vice Dean for Research, who will come and say a few words. And we will have maybe a time where we can put everybody in the waiting room except for the jury members so that we can deliberate and decide on your very uncertain fate. And I'll leave you now to start your presentation.
Okay, great. Thank you for everyone to join me today. So good morning. I really appreciate the time and effort. Looking forward to your feedback, comments, and suggestions. Okay, let's start. So my 3 chapters are all about Chinese banking and firm corporate finance. As you can see from the timeline, I draw a timeline here. So the Chinese banking sector's evolution over this period. So my first chapter highlights the entire, My first chapters highlight the entire, from 2001 after China joined WTO and until recently, so the overall bank-firm relationship. So the second chapter will focus on the rise of shadow banking since the 2008 stimulation package. So the third chapter will investigate the state-owned banks reformed around 2004. Okay, so it's a complete 3 chapters. Okay, so let's jump into the first chapter. So first, so today I'm roughly estimated about 35 to 40 minutes. I'll introduce the 3 chapters, but I will focus more on the first chapter because there's a lot of common background and common data set. So I will leave the rest of 2 chapters about 10 minutes or 15 minutes. Okay. First, I will introduce the background. Not only so as I said, I covered 3 chapters totally. So after I read many pieces of literature about how the bank-firm relationship can improve the corporate governance of the borrowing firm, so I began to question, does this also apply to emerging markets, especially like China? Okay, unfortunately, not very, very few papers have touched this area. Why doesn't really matter? So as I listed here, I made a table here. So the banks and firms are fundamentally different between developed and the emerging markets. So in the developed market, so most listed firms are held by diversified public investors. So conversely, a listed firm controlled by a business group is a universal structure in emerging markets. Regarding banks, the banks in developed markets are also listed in the stock exchange, so they're public companies. However, the banks in emerging markets, although they're partially owned by the public, they're still controlled by the central government. So as vehicles to implement the government's policies and strategies. Particularly, the top management teams are appointed by the central government. Given the bank's ownership structure, the banking industry is more open and competitive in the developed markets, and it's less competitive and more, I would say, that oligopoly in the emerging markets. So in short, with all the differences, can Chinese lending banks improve the corporate governance of a borrowing firm and reduce its shadow banking activities? So that's the main research question in this paper, the first chapter. Okay, so a little more extra information. So as you can see that, so among the 3 common financial channels all over the world, let's say the issuing shares, so the corporate bonds, or it's the commercial loans. Apparently, Chinese listed firms significantly prefer commercial loans. So this is because the Chinese bond market is really much less developed. Okay, so yeah, given that the Chinese listed firms heavily rely on bank loans, this generates a strong connection between banks and firms through the lending. So I'll call it a bank-firm relationship, so short for BFR. Okay. On the other hand, the company structure of the business group generate the so-called tunneling effect. So it illustrated as in this graph. So the parent, if for someone who don't know, so the parent firm has a control rights of the listed firm, and they can ask the listed firm to transfer some of its resources to either the parent firm or the sibling firms, right? So those are some private companies controlled by the same parent firm. So recently, some business group even create a new structure. They create intermediate financial companies. So in this way, it collects capital from the listed firm and redistribute it to other firms within the same business group. So I call all of those transactions the RPT, the related party transactions. So this includes the cash lending, guarantee, and other operational transactions. So such as buying or selling goods or services at a price higher or lower than the market price. In this way, they can manipulate their financial statements. So since this transaction includes the money borrowed from the lending bank, so the bank should execute its monitoring role as developed countries. So this is a core relationship I'm going to investigate in this paper. Okay, so why this study critical? So as you can see from the graph that the RPT is snowballing in 3 categories, especially after 2008, okay, which we will discuss in the next chapter. And now you can understand the background of this tangled relationship between Chinese firms and banks. So what do we expect from this relationship? Okay, from this literature, a strong bank-firm relationship can lead to strong corporate governance in developed markets. What we don't know and what this paper wants to study is that this also applies to the Chinese market, a market full of business groups, and the ultimate controller. It has a very powerful impact, both internally and externally. Under such a situation, can the bank still act its corporate governance role? So the first hypothesis here is a strong bank-firm relationship should reduce a firm's tunneling activities, both cash-related or non-cash-related. Okay, and secondly, this result comes from the improvement of the corporate governance of the stricter governance of a loan contract as in developed markets. So there's one more category of RPT in the Chinese market. It's called guarantee. It's kind of special here. So as I draw a graph to illustrate you, so a bank, another bank actually, lending to the sibling firm. It's not the initial bank lend to the listed firm. So the listed firm plays the guarantor role. So if the sibling firm you couldn't pay back, so that they go default, so the listed firm needs to pay back to the lending bank. So in this situation, this creates a asymmetric information between the banks and the firms, so both banks actually. So from this literature that less exotic private information and the more potential ex post frictions are the reasons to reduce the guaranteed lending due to the initial lending bank as the governance role existing here. So, but there's a particular case that since this including business group, so the initial lending bank, they can lend both to the listed firm and also they can lend to the sibling firm. So in this case, the lending bank collects more private information about the entire business group, about the sibling firms. And so due to a stronger bank-firm relationship with the listed firm, therefore, with more information available, the initial bank can allow more lending in such way, okay? Okay, so enough about the background. There's some and also hypothesis. So to examine this relationship, we truly need a unique data set, okay? So for the left-hand side variable, which is RPT, related party transactions, we need the transaction level data between the listed firm and their related parties. So since Chinese regulation requires all listed firms to disclose their related party transactions in the note of financial reports, so it's available in the reset database. This data set has detailed items, including transaction amount, its inflow or outflow. Here we only consider outflow, so from the listed firm to other parties. Also, it marks the relationship between the listed firm and the related parties. We don't take the listed firm's subordinates, but only consider the parent firm and other sibling firms. So it also provides a transaction category as a loan or a guarantee, or categorize the rest into the operation. Okay. So for the right-hand side variable, it's a bank firm relationship. So we need to create the measurements of a bank firm relationship. So to develop such measures. So if we only look at the balance sheet's aggregate liability, it's totally not enough to identify the direct relationship between one bank with one firm. So we need contract level data. Okay, so that's the difficulty here. We need contract level data. So I create an algorithm to extract such contract data from the listed firms' financial reports footnotes. So although it's not mandatory, most listed firms still publish the top borrowings from banks. It includes the lending bank, detailed to the branch name, the realized lending amount, at the grade interest rate, and also the contract's tenor, the duration of the loan. Okay. So to confirm the quality of the data, I compare it with the actual cash borrowing events. So this data set covers 96% of the borrowing decisions. So since the listed firm only disclose their top loan contracts, so this data set captures 83% of the new borrowing amount. So compared to there's an item on the financial report called the new borrowing. So that's an aggregate item. So compared to that, we captured 83%. So overall speaking, this lending contract data set is relatively representative. Okay. After the availability of the loan contract information, we can now create the measurements of the bank firm relationship. Following the literature, there are two measurements. We can use it as a proxy to represent different relationships channels. So proximity, which is one measurement by the physical distance between the lending bank branch office to the borrowing firm's headquarters. So it means the soft information about a bank, what a bank can gather from the listed firm. A bank knows more about the company if it's closer to the company. Okay. Another one is the equity exposure. So most commercial banks in China not only have the credit department, but also have the investment department. So suppose a bank creates a fund and invests into a listed firm, so that which is also borrow from the same bank's credit department. So in this case, this creates opportunities for inside information. So we have the data for of each listed firm's top 10 shareholders. So they disclose that in their financial reports as well. So we can identify which fund belongs to which bank and whether the bank also lends to the firm. So, okay, so the rest of control variables just come from the financial statements, also from the reset database. Okay. So I believe you that you can sense that the simple OLS linear regression is not very appropriate to study this relationship because there are two critical issues. So first, the selection bias. So that exists because the relationship between bank firm relationship and related party transaction is conditional on the firm's decision to borrow from a bank first, right? So when one firm decides to borrow from one specific bank, but not another random bank or doesn't borrow, so the selection bias arises. To solve this issue, we apply the lambda from the Heckman model to correct the selection bias. But secondly, endogeneity bias might exist due to the omitted variables. So for example, a firm with less related transactions is more likely to borrow from banks that already hold high equity shares before lending. This could cause reverse causality as well. So to address this issue, we need to introduce instrument variables and apply a two-stage model to solve this. So here I use some commonly used IVs from literature. From the proximity side, we use the firm's headquarters distance to the nearest city level branch of any banks. So since this level branch founded much earlier than a listed firm. On the equity exposure side, we use the average equity exposure of peer firms in the same industry that also initiate a loan in the same year as this loan deal. Okay, so in this way we can satisfy the exclusion restriction. So there are other set of instruments at the industry level. Also, some of them cover the related to the local banking market characters. So I'm not talk all details, but so all the variables are measured in the year before the inception of the loan. Okay. So after addressing both issues, so now we can put the lambda and also instrumented bank firm relationship variables so into the primary regression model. This regression runs at the loan contract level for loan contract J. So it's at the contract level, it's very important, and the borrowing firm I. Okay. So because we want to examine how the bank firm relationship, so which is built up by each contract, so impacts the related party transactions. So therefore, we need to evaluate over the tenor period when the lending contract is still effective. So for the left-hand side, we average over the tenor period of each contract. We average over the same tenor period for the control variables on the right-hand side, but before the contract starts. So if say you have a contract start at time t, so from time 1 to time 5, so that's a 5-year contract. So that's what we evaluate in the field for the future part, but we use from -5 to -1 to evaluate to measure the average control variables before the contract starts. Okay. So applying this regression model, we can now start to examine the primary relationship between the bank firm relationship and the related party transactions. So this table shows that the proximity and the equity exposure negatively impact the direct lending from the listed firm to its related parties. So, So when the bank is closer to the borrowing firm, it gathers more soft information about the firm. The bank can make a monitoring effort to reduce tunneling activities. So the only channel to the bank can utilize is the loan contract itself. So you can see from the negative regression, negative coefficient here, also to the RPT operation side. So on the other hand, when the bank can receive inside information about borrowing firm's RPT plan, it will also intervene and force the borrowing firm to control this behavior. Since the bank also participates in the board meeting, it will encourage the borrowing firm to take less RPT loans, also less operation outflow. Okay, wait a second. Okay, so meanwhile, we separate the RPT also in as I told you in the hypothesis part. So we separated the RPT in guarantee into 2 categories. So first, if this same bank lends to both the listed firm and the sibling firms. Also, second one is a different bank involved in this guarantee lending contract. So we can see from the column, the first 3 columns, that when a bank's contract to this guarantee lending, it encourages such behavior in the same business group, as long as the lending bank participates in both contracts. The results are significant, both statistically and economically. So, however, on the other hand, when the initial lending bank doesn't participate in the contract with the related borrowing firms, it will limit such tunneling activities. As you can see from the equity exposure, it is negative coefficient here. Okay, so both this prove the hypothesis 3. So a stronger bank firm relationship, they will facilitate the guaranteed lending to the related parties with the same bank lender, yet it reduced the guaranteed lending with a different bank lender. So now we can see, now we have seen the impact of bank firm relationship on the reduction of the RPT loans and also other categories, but we don't know how this happens, so through which channel. So as shown in the previous page, the proximity measure only collects soft information. So the only channel it can impact the firm's behavior is to use the loan contract, right? So here we use the loan contract terms on the left-hand side, as this one. So now we can investigate how the bank firm relationship before the contract it will impact the contract covenant at time t. So as a result shown in this table, when the bank gathers more soft information about the borrowing firm's RPT behavior, it tends to reduce the lending amount. So reduce the lending amount also, but it will increase the interest rate and also shorten the tenor period. So both those impact on the contract covenant. So this way they can reduce the default risk, or they can compensate the banks for taking the risk. Okay, So, but how equity exposure impacts the reduction of RPT? So the answer is corporate governance. So since the lending bank is one of the top 10 shareholders, it plays a critical role in the board. So now we're replacing the left-hand side to the corporate governance variables. We use the ones very commonly used. So you can see that with more equity exposure, can reduce the dual job directors percentage. It will increase independent director percentage. Also, it will increase the chance that the probability that the CEO and the chairman, they're not the same person. So this way, which all three characters represents the better corporate governance. Okay, to summarize, by the way, there's some other supplementary analysis I don't have time to cover today, so you can read the paper to know more. Okay, to summarize, as you can see here, so a stronger bank-firm relationship is better govern this the borrowing firm's tunneling behavior and reduce this related party transactions. A closer proximity and or more equity exposure, they can reduce the RPT through different channels. Okay, so the Chinese commercial banks, so they can act the same monitoring role as the banks in developing markets. Okay, so furthermore, the tunneling is one category of shadow banking. So to control the shadow banking, the central bank should encourage commercial banks to closely monitoring the borrowing firms to reduce the second-hand lending. This shadow banking behavior can only be reduced but not eliminated. The mechanism, that's why I'll address it in my second paper. Okay.
Can I ask you
the second chapter here? Yep.
Can I ask you a question? I mean, just from a pedagogical point of view, it would have been interesting to show what is the relationship with stock market performance. Yep. I mean, there are many people that have the strong sense that Chinese stock markets suffer from a huge negative selection issue, and that's exactly what you are measuring. Yep. Right. So, I mean, you could do this at the general level where you show the relationship between stock market underperformance and related party transactions. And secondly, the relationship with your instrumented one. Are they similarly strong, and do you pick up a large part of this negative selection?
Yep, right? You're right.
I mean, just to give people a sense that you are talking about something that is of huge qualitative importance, and it also sort of would make a link towards asset pricing and majorly increase the sexiness of the paper, because asset manager wonder how can they identify the very Chinese firms that are less suffering from this, no? Yep. And if you give them a sense that, look, by avoiding these firms, you can gain another 5% on your Chinese equity portfolio, that would be a huge message, right?
Exactly.
Just in terms of impact. I mean, it has nothing to do with your channels or so, but yep. Just to place into a bigger picture.
I see.
Right?
Good point. Thank you. Thank you very much. Okay, so let's continue. So from the first chapter, you can see the shadow banking indeed exists as a format of firm-to-firm lending, but how and why this happens. So that's the triggering event from my point of view. That's a 4 trillion stimulation package in 2008. Okay. So some background, a little bit extra background. So you're referring to Economist and the Wall Street Journal's media report. So you can see that. So it's a clear skyrocket boost since 2008 for this shadow banking lending, and especially the firm-to-firm lending. That takes a large portion out of that, which is the part I measured in the last chapter. So that's why it initiates the research question in this paper. So why shadow banking arise rapidly in China after 2008? And why, and also who are the participants and their characteristics? So what is the mechanism behind this shadow banking? Okay. So first, we built up a theoretical model to endogenize this generation of shadow banking. So we use empirical evidence then to demonstrate it afterwards. So this model, so probably I don't have enough time, but I will basically introduce the fundamental setup for this model. So it's a model built up on top of the Holmstrom and the Tihola's classical 2-period firm bank model. So the firm has a project, so it requires the capital 1 to invest, but the firm only has the capital W. Okay, So it needs external financing at least 1 minus W. So in this way, they can start the project. The project might be successful based on the probability P. And if it succeeds, the project payoff, that'll be Q. So if the firm borrows this amount from bank, then it needs to pay back this amount RB back to the bank. So the firm's entrepreneur needs to spend some effort, which that effort will here we just for easier calculation we equals to P to increase the probability success probability. Okay, so that will reduce the utility by the marginal cost, which is beta. So the bank side, they want to spend the monitoring effort, which is this one, the monitoring effort. In this way, they can alleviate the more harder issue to push the entrepreneur's effort and make the project succeed. Okay, so this is the fundamental setting of the entire model. So probably I don't have time to cover those details. So basically, that's the way we do that is to first consider the benchmark situation in the competitive market without shadow banking. That we can solve this optimization issue. So then the firm wants to maximize this payoff. They can support the project without external funding. That will be the optimized effort they have. But if the bank lends to the firm, it needs to maximize the payoff as well. So it'll push the entrepreneur's effort from this one to this one. Okay. So since this is a competitive market, the borrowing firm can decide the borrowing amount and the bank payoff. So to solve this equilibrium optimization issue, problem, then we can see, so only the firm with capital larger than this number, this variable, they can obtain the bank loans. Okay. So then once we have the benchmark status, so we'll consider the emergence of shadow banking, so which is that the firm wants to borrow more than it needs and lends to others because it can gain extra payoff from the shadow banking behavior. So, so this is the rate here to represent the lending rate of the shadow banking. So once we solve this optimization problem, we'll find that only when a firm's capital W satisfies this condition, so when it's larger than 1 minus IBS, the firm will over-borrow from the bank and then invest the extra capital in shadow banking. Okay, so I think this graph can help you better understand the whole structure, also the conclusion of those models. So, so who are also answered the question earlier I asked, who are the participants and their characteristics. So firms, so the below this part, with below a W and under bar, they couldn't borrow from anywhere, neither commercial banks, neither shadow banks. And when this is a credit rationing issue. So when the firm's capital, which is larger than this part, which is actually I mark here, okay? So it will overborrow and they become the shadow banks. So those are large firms, larger than this amount, okay? Then the firm's capital stays, when it stays within these two range, W1 and W2, so they are the ones to borrow both from the commercial bank and the shadow banks, which they're not having enough credit in the shadow bank. So, and there's the amount exactly, that's the amount they borrowed from this shadow bank. So the rest areas, those parts, they only borrowed from a commercial bank. Okay. So now we should ask, what if the banking sector is non-competitive, so that which is like China before 2008? Okay, and in such cases, banks dominate all decision making to maximize their payoff. So now we need to optimize all variables together. It will push the firm to borrow only the minimum necessary amount of capital. So therefore, the shadow bank doesn't exist. So in this way, we can answer one question. The rise of shadow banking is because the banking sector transfers from a non-competitive market to a competitive market. Okay. Last, also this graph can be very helpful for you to understand what's the mechanism behind the shadow banking. Okay. Once the let's see if I can draw something here. So once the large firm overborrows, which is this part, large firms, they overborrowed from the bank, then they will enjoy a low interest rate. They will enjoy a low interest rate which is at this level, okay, then I can relend to the medium-sized firms at this blue line, which is this part, okay? So they lend as this, so they borrow from the commercial bank at a lower rate, and then they relend it to the medium-sized firm at a higher rate, which in this way, they can gain this higher ratio, okay, higher rate, interest rate. So the medium-sized firms, they also prefer to borrow from the shadow bank because the shadow banking, which is only this part, right? Only as I showed you in the previous graph, only this part of companies, they will borrow from shadow banks, but they will enjoy also a lower lending rate, which is this blue line from the shadow banks than the ones from the commercial banks, okay, which is reduce their rate lower, okay. So therefore, this way they create a win-win situation actually. So it generates the room for shadow banking. That's the mechanism behind it. Okay, so on the empirical side, for the ones who doesn't know, I introduce a little bit more. So the China market before and after 2008 is very similar to the theoretical model we designed here. So it transfers from a much less competitive market to a relatively competitive banking sector. So this is triggered by the event on November 9th, 2008. November 9th, 2008, that so the Chinese government delivers a 4 trillion yuan stimulation package to drive the economy out of the depression of the global crisis in 2008. The real effect is much larger than 4 trillion yuan because there's one crucial item in this package that was to remove the loan quota limitation of all state-owned commercial banks. This policy comes out is because the People's Bank of China, the Chinese central bank, they has controlled the volume of loans from state-owned commercial banks to prevent an overheated economy before 2008. However, the global financial crisis in 2008 also impacts the Chinese market. The government was eager to stimulate the domestic supply and demand. Therefore, after the announcement, state-owned commercial banks can lend to firms without the quota limitation concern. So, and the bank sector becomes relatively more competitive, okay? So we use some data to show that, as you can see here, use the similar variables we had in the last chapter. So RPT, I use that as a firm-to-firm lending. So after the policy is significantly increased, okay? On the other hand, I use HHI index to measure the competitiveness of the banking industry. So as you can see here, the HHI decrease in all perspectives, which demonstrate the reduction of concentration and the increase of competitiveness in Chinese banking sector. So next, we want to demonstrate that the large firms become the shadow banks after the market becomes more competitive. So we can use the policy dummy variable to interact with a big minus small indicator on firm size. It takes the average firm size of the top 30% each year, the minus one of the bottom 30%. So this difference also applies to the RPT loan outflow for the same time. The regression results show that you can see that the large firm participates in more firm-to-firm shadow bank activities after the banking sector becomes more competitive. So in the two hypotheses we bring up, we claim that the bank lending rate is the key factor to cause shadow banking to emerge. So as you remember in the previous chapter's data set, we have this loan level, contract level data, right? So we know the interest rate. So in this way, we can use this measurements to interact with the policy dummy variables. Then you can see that a larger firm can get a lower interest rate, also which creates the motivation for large firm to re-lend the extra capital to medium firms. When the loan size becomes larger, so the bank will charge a higher lending rate, which is right as well. And the bank lending rate is higher to firms that become the creditor of the shadow banking than firms not engaged. So which means that as the same graph showed in the previous pages. Okay. So for the last hypothesis, we claim that the shadow banking will decrease the economy's real efficiency because it creates additional default risk. So we use the common variables like Altman Z-score, the free cash flow, and the interest coverage ratio. So as the default risk proxies. So the regression result shows that the listed firm lends out its capital to other firms in the shadow banking sector. Those firms, their Z-score, free cash flow, and interest rate, they all decreased, okay, significantly. So this demonstrates that their default risk indeed increased along with the increment of the shadow banking behavior, okay? So to conclude this, this chapter, so the shadow banking is as a market reaction to the increased competitiveness in the banking sector. So firms with large capital, they will obtain the bank loans at a lower rate. So they tend to overborrow from banks and lend to the extra tech capital to the medium-sized firms. And although they increase the firm's profit, but reduce the real efficiency of the entire economy. Okay, so I don't have lots of time, but I will move to the next chapter. So quickly summarize it. Okay. Sorry. Sorry, wait a second. I think the sharing has some issue. Wait a second. Let me reshare my iPad here. Okay. Okay. So wait a second. As you can see from the third chapter, so when we rewind the time a little bit back to 2008, when China joined the WTO in 2001, actually in Geneva, so the government committed to the world that China will open the market gradually, especially the banking industry, to make the local commercial banks to be able to compete with foreign banks. So the Chinese government decided to reform all state-owned commercial banks, starting from the largest 4 banks. Okay, so the big 4 state-owned banks, short for SOB here, experienced the reform at different time point. As you can see, there are 2 banks. They reform in 2004. There's 1 bank in 2005. There's another bank in 2008, which we don't use it in this paper because from the second chapter, you know that it coincides with the stimulation package. Okay, so the importance is it's evident, which because those 4 banks occupied more than 60% of China's total lending. So the reform focused on how to dispose the non-performing loans and improve their internal governance. Okay. So that's as my first chapter shows you, the Chinese banking industry becomes more efficient. It plays a more important role as developing markets. Clearly, it's not the case back in 2000, as you can tell from the non-performing loan, right? So what happened in this reform? Does it truly improve the efficiency of the state-owned banks? Does the bank reform improve the efficiency of the whole economy by improving its credit allocation? Does the bank reform improve the performance of borrowing firms? So those are key research questions we're about to address in this chapter. So here, the key to implement this study is to find a clear identification strategy. However, we don't have the bank lending's detailed data for each state-owned commercial banks, not even the aggregated one on the city level. So therefore, we have to find an alternative indicator. Since we have the province level data and the bank branch information from each bank, so we'll create this indicator as in this way. So we want to design the way that the firms in cities with greater horizontal exposure to these SOBs, which is back in 1999, before all the reform starts, so they can acquire more bank credit than firms in cities with smaller exposure. So this method is based on the condition that the firms in cities with greater exposure are more likely to borrow from those SOBs. So for any one of the reform bank B, so its exposure at the city level equals to the loan share of this bank at the province level where the city belongs, multiplied by a ratio of share of SOB branch in the city level, which is, you can see C here. So over the share of the SOB branch in the province level, which only have P here. So to include some time variant at the city level, since the reform timeline is different for 3 SOBs, the exposure is conditional on the bank's reform year, as you can see here. Okay. So the key, so this is our indicator to use. We'll draw the graph for the Chinese maps, so how it distributed across China. You can see there are 330 cities in China, which creates the variation of the exposure indicator. Okay, the primary regression model we applied in this chapter, we use a difference in difference and also DDD, difference in difference model. So we interacted the big three exposure with firm characters such as debt ratio, loan to asset ratio, etc. Okay, so I'll skip this part. We just scrap data from the CBRC and also get data from the statistical yearbook. So our first result is based on the interaction term. We can see that no matter listed or unlisted firms, as you can see here, no matter it's listed ones or the unlisted firms, so the bank reform reduced the lending to more indebted companies. This impacts both short-term, also long-term loans. The next step, we add a dummy indicator for years around 2003, so we can use a DDD model to further check whether the bank ownership reform changed bank behavior dramatically within the short period or gradually over period. As you can see here, so before 2003, so more in-depth firms have a better credit access. So they have so you see here, they have a more prominent in cities with greater exposure. But after 2003, so more in-depth firms have worse credit access in cities, okay, higher, which has a higher exposure. So finally, we would like to study whether the bank reform contributes to a positive link between firm productivity and credit access. This matters for resource allocation efficiency, also matters for the long-run economic growth. So we use the earning before tax to initial assets to represent the firm's profitability, and use the change of firm's fixed investment for the investment rate. So this table shows you that after the bank reform, it reduces the bank lending to SOEs. You can see here, it reduced the bank lending to SOEs and the low TFP firms, low productivity firms. So furthermore, both SOEs and the low productivity firm experience a significant decline in profitability and also in the investment rate. So together, this has a large positive effect on long-run economic growth. Okay, so to conclude in this chapter, we find that during the Chinese banking industry reform, more indebted companies experience a more substantial decline in credit access in the cities that were more exposed to the reform. So the bank reform pushed the loan officers to consider more credit risks in the lending process, which echoes the conclusion in my first chapter. Bank reform further reduces bank lending to SOEs and less productivity firms, which have positively effects in the long-run economic growth. Okay, thank you. I think that's all my presentation.
Thank you very much for a very clear presentation and for being very short. A lot of things to say, but not a lot of time. So we're gonna start by having the jury member comment on your work and maybe ask a few questions. We're gonna start with the external member. It's not completely external. Philippe, you're almost one of us. So we'll start with you, Philippe Bantin, with your question and comments. Thank you.
Right. Thanks very much, Tony. Thanks, James, very much for this very nice presentation. And overall, I think it's a very nice dissertation. So I have one kind of a bigger question, which could be something to think about for kind of future projects or for extensions. And so you talk about, so your dissertation is about the Chinese banking industry, shadow banking, and the kind of the real effects of that. And so one thing that we have seen a lot over the past couple of years more maybe, and that has been written about in the financial press and in research in the Western countries, is the rise of zombie firms, right? So these are firms that are kept alive by the banking industry, but in some sense they should not be kept alive because they're not profitable. So I was just wondering, given that you're the expert on the Chinese banking sector, are zombie firms, is that a big issue in China? And the second question is, has there been an increase in the proportion of zombie firms? So since that financial stimulus that you analyze in chapter 2? And maybe as a kind of final question is, to what extent could there be an interaction between, you know, the presence of zombie firms and shadow banking? I don't know if you have some thoughts on this, very general. Thank you.
Thank you. Should I answer that at the end, or can you respond now? Or?
Maybe go ahead now and
yeah. Okay. Yeah, I think that's thank you, Philip, for this those very insightful questions. Indeed, there's zombie firms always an issue, and also you see in the last chapter the non-performing loans. Actually, I think a lot of large portion of that were distributed to those zombie firms, make them still alive for a few years. But that's indeed a good question. I need to discuss this with my co-authors. I think since we have this the manufacturing level data, so I think right now it's updated until 2013, so we can make a measurement, try to see the before 2008, and also around the before and after the banking reform, how those zombie firms perform. If there's a better indicator to find out those zombie firms, I think indeed that's a very good research question. Thank you.
So we can maybe move now to Philippe Cruyère.
Yeah, guys, I'll be really brief because I think I asked one of my questions in the pre-defense, and James responded to this. So I also would like to congratulate you. I think this is a very nice and interesting thesis and dissertation. So I enjoyed reading it a lot. I think that it's a really nice overall theme on the role of banking in developing markets and what we can learn from China, right? Being such a special setting. So I thought you did a great job in kind of combining both theory and empirical work. So I thought it was, it's quite diverse dissertation from a methodological point of view. And I think you also did like a great effort in collecting all these data, right? Because I guess that must have taken a lot of effort, and I'm sure you could probably leverage this in the future and perhaps write more papers using these data. So overall from my side, it's really just general assessment of the thesis, since we already discussed the details in the pre-defense, and we responded to these. So that's about it.
Okay, thank you, Philippe. Should we do Harold first and then me at the end, or the other way around?
Up to you.
Okay, Harold first.
But very short. I think I don't know where you stand on the publication front with the first chapter. I think something that would also make the link to performance more directly, as I mentioned, that could be actually a spin-off paper. I think that could have large general appeal. I remember reading one other paper on related party transactions, but it was a very early JFE paper. I think maybe updating this and providing more an asset pricing focus could be interesting, I think, as a derivative paper, right?
Yeah.
I think there could be a lot of
actually,
what are the adverse selection problems within and do they show up in asset pricing of these firms? To what extent it's priced a priori? What kind of Tobin skews do you obtain from it, and so on? Right?
Yep, you're right. Yes.
That's basically it. I think would be interesting to pursue this further.
Yep.
That's my suggestion.
You. Yeah, indeed. I'll consider that to the stock. Add the stock return part. I think I did at some point, but I didn't continue.
What did the referees on this? You submitted this. What did did they not request this, or?
I haven't submitted yet, but yeah, I will definitely go that direction. Yes.
Okay.
Yeah.
That's it.
Thank you, Harold. As for me, well, I've asked most of my question in the previous defense, so I don't have much to add. I just have one comment that might be important, especially if you're going to submit some of this work now. You've probably followed the recent default by some state-owned group, Zhicheng, Tsinghua Holding, very close to us, defaulted on huge bonds, and it's interesting that this it raised concern about the banking links of these companies, especially Zhicheng. They have this massive debt with banks, so not on the bond side, but the direct borrowing from banks. So I thought it was interesting to put this in comparison with what you're saying in your last chapter, right? That after the reform, banks are doing very strict monitoring and they're following all these state-owned enterprise. And it seems that at least in some cases, it didn't work at all, right? So they were just granted massive loans without much scrutiny. And this Zhicheng Automotive Group, what they've been able to do with all this money is pretty insane, right? They bought a quarter of BMW and they did all this stuff. And basically they were sponsored by the Chinese government to expand. And this is a political decision. And there is a political aspect in all this lending decision, and which industry should grow and which one should get more funding and how hard the funding should be. And I think what you're doing kind of speaks to that, and it would be interesting to I don't know, integrate some of these elements. You do in some of the paper. So you have this state-owned enterprise dummy in the first chapter, for example, but apparently it's not significant. And it might be interesting to look a little bit deeper into that, maybe for some further work. But that's all I have.
Yeah, you're right. You're right. Indeed, I think in the last chapter, when we testing this bank reform things, that indeed the SOEs, they will have less access to the credit access. I think, and also it's right. I also look at the recent cases. As I said before, so in China is only moving from a non-competitive market to a relatively competitive market. So actually, indeed, there's a lot of rooms for the corporate governance, banking governance, the monitoring roles to play. Apparently, they are still very premature. It's not reaching to the developed market level yet. But indeed, yes, that's a good point. Also, the political issues, indeed. I think actually there's one paper I didn't include into my my dissertation here. At the very beginning of my research, I trying to figure out the political connections between the Chinese firms to the banks to the others, but that didn't work very well. So then I turned to other three papers. Yes, the political connection, that's definitely one critical issues actually in China, no matter it's firms or banks. Yeah.
Thank you. So rather than putting all of you in the waiting room, I think what we're going to do, I've sent an email to the jury member with another private Zoom secret meeting just for the jury member, so that we can deliberate for a few minutes and we can leave all you guys together. You can start congratulating James, and we'll be back in a few minutes. So Harold, Philippe, and Philippe, maybe we can leave that meeting and join the other one, and see you there in a minute.
Thank you.
Harold, did you get the invite as well? It was sent by email. Can't hear you, Harold. You're on mute.
I don't have the link. So when was it sent?
5 minutes ago.
No.
Okay, let me try again.
Here we go. Okay.
You have it?
Yeah. So can we? I have to go out of this meeting and go to the other. No.
Exactly. Leave this one and join the other.
Okay. Good.
Okay. I don't know why they don't put themselves in the breakout rooms, but yeah. Where's Alexandra? He's supposed to be here. Anyway. Oh. Are you back to home? Everything's fine on the trip? Okay, you're muted.
Yeah, all good. Just a bit of snow, but not too much. So yeah.
There's snow. Okay, I think it's across the tunnel. It's really snowy before the tunnel.
Yeah, usually you see the sun, but it happens that you also have the snow here, not in Geneva.
Yeah, the other day I saw that all the snows, rains, just focus on the east side of Switzerland. Around they all surpassed the Lemon Lake part.
Also in Italy, they had a lot of bad weather, raining, storms, and everything. Yeah. This is the climate change.
Oh, okay. It's very interesting that my son and myself, we both have exam today. So he also had an exam to kind of like a big exam today. So, so last night, both of us were rehearsal at home.
Did you get some more feedback from the Chinese students from the weekend, or?
Huh?
Did you get some more feedback from the Chinese students in the weekend, or?
I can't 10-ish. I didn't check that for a second. We'll push them anyway. So yeah, 12. No, not that much, not that many yet. We'll give another round push after today. Yeah. I'll get back.
Okay, are we all back?
Harold, not yet.
Harold is on his way.
Okay, he's here. Yeah.
All right. So we have deliberated very rapidly because there is absolutely no doubt in our mind that you deserve this new title of Doctor in Finance. So congratulations, James, on earning this very well-deserved PhD. Your work is very diligent. You did very well, and you should be proud of yourself. So congratulations.
Thank you. Thank you. Thank you, everyone.
And I will just leave the floor to Salvatore Di Falco, Vice Dean at the Zhicheng, to congratulate you as well.
Well, good morning, everybody. It's a true privilege to be here with you. On behalf of the Decana of the Geneva School of Economics and Management, I just want to take a few minutes to congratulate Dr. James for reaching a great milestone and a wonderful contribution to our community after a very long journey. As you will know, the production of high quality research is a key strength of our faculty, and James' work goes straight in that body of literature that we contribute to. Thanks so much, James. I also like to thank James for being such a great citizen. Your contribution to the school has been appreciated in all the possible dimensions. You've been a wonderful TA and a great friend for many of your colleagues. So thanks a lot for being with us. There is a small gift for you, which unfortunately, for obvious reason, I'm not able to deliver to you today, but I will find a way to get it shipped in some way or another.
Thank you.
I also would like to take the opportunity to thank your thesis advisor, Professor Al and Professor Kruger. They spent an enormous amount of work with you, and this is something we tremendously value in our faculty. They mentored you and they supported you through this very important process. And of course, thanks to Professor Philip Valta from University of Bern for being such a great external member of the jury and providing us with lots of comments and supporting us during the process. And finally, last but not least, thanks so much to Tony Berrada, Professor Tony Berrada, to being the chair and the professor of this jury for managing the entire process so smoothly as usual. So, James, I wish you a wonderful career.
Thank you. Thank you so much. Thank you.
Thank you very much, Salvo. So we're gonna give you the floor back, James, if you have what you want to say to conclude this event.
Yes. Really, first, thank everyone to join my public defense today. So some of you don't know that this actually has been 10 years since I came to Switzerland. So I came to Geneva back in 2010. So I have my first 2 years in UNIO for master, the 1 year in the SFI, the doctoral course, then the 4-year research in Geneva, then the recent 3 years, 95% I work, and 5 to 10% I still continue my thesis to finish my thesis. So there are so many people. I would like to take this opportunity to thank you. That first, of course, my committee members, first my supervisor Harold Howe, and the Professor Harold really gave me lots of freedom to choose my topics, research topics, and always support me to pursue it in direction I'm interested with. So and every time when I reach to him to discuss my ideas, he always can brainstorm and generate lots of new ideas, can inspire me. And you can see from the defense today that he also bring up new ideas again. So it's really tremendously thank you. And also really, I would say I always think about that's a great chance at the very beginning, back in 2012 or 13. So after the first time I meet with you to discuss whether I can follow you to pursuing my research career, and you really my great honor to have you be my supervisor. So thank you very much. Really appreciate that. And also the other, the Professor Philip Kruger and the Professor Philip Valta, that you two gave me lots of advices in the previous defense, also during the lots of long periods. So that really helped my thesis to reach to a new level, truly. But last but not least, thank to the Professor Tony Berrada that we worked together actually in the past 3-4 years. I really learned a lot from you, not only from the academic side, also the ways to work the ways to coordinate, to play different roles. Okay. So another side, I want to thank my co-authors. Like here they are here today as well, Wei Yuan and Ouyang Difei. And also I have another co-author for my second chapter. That's Liu Ying. She's already in Shanghai as assistant professor. So really thank you all of you. And without yours, without our brainstorming, your help, your contribution, there's no way I can finish all 3 chapters by myself. So really, thank you very much. And also I want to thank my working colleagues in both the Geneva Institute for Wealth Management and also AfroCruncher. I think I don't see Alexandra here, but indeed, and I saw Marlo here. They gave me lots of support at my back. So without their help, their push, I think it's really hard for me to go through those, to finish my thesis in the last 3 years. Yeah. Last but not least, of course, my family here. I see my parents here and my wife here. So they also I really thank my 2 naughty but adorable kids. So they really support me a lot in all the period, all the 10 years when I'm here in Switzerland. One case, a very recent case, just last weekend, over 4 days, we have a course to teach for our Chinese students. So without their support, I don't even have time to work on my rehearsal for the public defense. So that's just one piece of example. There's trillions of examples there in past years. Okay, thank you everyone to join my public defense today. Really appreciate your participation. Thank you.
Thank you very much, and we will see you soon. All of us, most of us, will still be working with you on our
exactly
RAPS program, and so it's goodbye, but not for too long. So
yep,
enjoy.
Thank you.
You should be proud of your contribution of your work.
Thank you so much.
Bye.
Bye. Thank you. Bye.
James. Congratulations. Bye, James.
Bye.
All right. Thank you.
Thank you.
Bye-bye. Congratulations, James.